What happened today was not normal. It did not appear on most financial news tickers, and it was not explained in the usual market commentary. But for those who understand how the system really works, today marked a turning point in the silver market. On Tuesday, January 13th, 2026, while most traders were focused on price charts and short-term movement, two powerful institutions acted behind the scenes. The Chicago Mercantile Exchange quietly issued an emergency rule change. At nearly the same time, the United States Treasury called an unscheduled meeting of G7 finance ministers. Officially, the topic was critical mineral supply chain security. To those who study market structure, that phrase has a deeper meaning. This was not routine administration. It was a response to stress inside the system. Let us begin with what happened at the exchange level. As silver approached the mid-$80 range per ounce, momentum accelerated. The market opened with a sharp upward gap, moving from the low 80s into the mid-80s within hours. For traders watching closely, it was clear that large positions were under pressure. When price moves quickly in a heavily leveraged market, the risk does not stay evenly distributed. It concentrates on the weakest side. Then the CME acted. Through an official notice, the exchange changed the margin structure for precious metals contracts. Instead of a fixed dollar amount, margin requirements were recalculated as a percentage of the total contract value. Under the new rules, traders were required to post approximately 9% of the contract's notional value. For participants holding silver contracts near recent highs, this meant a sudden increase in required capital of roughly 15% per position. In practical terms, traders were given only two choices. Either they could provide thousands of dollars in additional funds almost immediately, or their positions would be automatically liquidated by the exchange. This type of adjustment is not neutral. It is a mechanical pressure valve. When margin requirements rise abruptly, leveraged positions become vulnerable. Forced selling follows, not because traders change their outlook, but because the cost of participation has been raised mid-trade. We have seen this mechanism before. In previous market cycles, margin increases accelerated declines, pushing prices down rapidly even when underlying demand remained intact. History has shown that when leverage is targeted, the market can appear to reverse violently. And at first, today looked like it might follow that script. As news of the margin change reached trading terminals, silver dropped sharply. Within minutes, the price moved down several dollars. Short-term charts turned red. To outside observers, it looked like the rally had failed. Instead of continuing lower, the price stabilized. A deep intraday dip formed, but buyers immediately entered the market. Within a short period, silver recovered a significant portion of the decline. The market did not collapse. The forced liquidation occurred, yet the price refused to break down. This reaction tells us something important about who is buying. Margin changes only affect leveraged participants. They do not impact buyers who operate with cash, long-term supply contracts, or physical delivery needs. Industrial users, strategic purchasers, and large non-speculative entities are not subject to margin calls. When prices temporarily weaken due to mechanical selling, these participants often increase their buying. In other words, the selling pressure came from the paper side of the market. The support came from the physical side. This suggests that two different systems are now operating simultaneously. One is the futures market, shaped by leverage, rules, and regulatory mechanics. The other is the real-world market, driven by availability, demand, and long-term necessity. When these two systems move in opposite directions, short-term price action can become misleading. The margin increase did exactly what it was designed to do. It removed leverage from the system, but it did not eliminate demand. Instead of triggering a collapse, it exposed the depth of buying beneath the surface. While this was happening in Chicago, another development was unfolding thousands of miles away. In Washington, the U.S. Treasury convened an emergency meeting with the finance ministers of the G7 nations. These meetings are not scheduled casually. The G7 represents the core of the global financial order, and unscheduled sessions are typically reserved for systemic concerns. The official statement referenced critical mineral supply chain security. To most readers, that language sounds bureaucratic and abstract, but in context, it points to something far more specific: access to essential materials that underpin industrial production, energy infrastructure, and advanced manufacturing. Silver is not just a financial asset. It is a strategic material. It is used in electronics, renewable energy, medical technology, and defense systems. When governments begin framing supply as a security issue rather than a market issue, it indicates concern not over price, but over availability. Taken together, these two events, the exchange rule change and the emergency government meeting, suggest stress within the system that is not being openly discussed. The exchange moved to control leverage. Governments moved to address supply. These are not reactions to speculation alone. They are responses to structural pressure. What makes this moment different from previous cycles is that the usual tools appear to be losing effectiveness. In past episodes, raising margin requirements caused sustained price declines. Today, the same tool produced only a brief disruption before buyers re-entered the market. That is not typical behavior in a market driven purely by speculation. It suggests that demand is no longer just financial, it is operational. This does not mean prices must move in any single direction. Markets remain complex, volatile, and influenced by many variables, but it does mean that something fundamental may be shifting beneath the surface. When institutional mechanisms designed to cool momentum fail to do so, it indicates that the underlying forces driving the market are changing. The broader implication is not about short-term price movement, it is about structure. A market supported primarily by leverage can be controlled by adjusting rules. A market supported by real-world necessity cannot. What we are witnessing may be the growing separation between paper pricing and physical reality. One responds to margin, liquidity, and policy. The other responds to scarcity, production, and industrial demand. Understanding which system is moving the market at any given time is essential for interpreting what price action truly represents. This is not a call to action. It is not a forecast. It is an analytical observation about how market mechanics, institutional behavior, and physical demand appear to be interacting in a way we have not often seen before. What happened today was not simply volatility, it was a stress test, and the system did not react the way it used to. In recent months, global commodity markets have been shaped by developments that many analysts describe as unusual, interconnected, and worth examining closely. Among these developments is the situation surrounding silver, a metal that has historically served both industrial and monetary functions, and which continues to attract attention from investors, manufacturers, and policymakers. Headlines surrounding a recent emergency gathering of the Group of Seven, G7, finance ministers, framed around securing critical mineral supply chains, have generated renewed public interest in understanding how silver fits into the larger economic landscape. While dramatic interpretations often circulate quickly online, a calmer, more neutral analysis reveals a broader context involving supply constraints, industrial modernization, energy transitions, defense manufacturing, and international trade. Rather than attempting to predict price movements or advocate specific financial behavior, the interest of governments and alliances such as the G7 in silver does not necessarily imply shortage, crisis, or strategic confrontation. Instead, officials often monitor materials that could influence industrial capacity or national security under certain future scenarios. Many analysts note that discussions about minerals such as lithium, cobalt, nickel, rare earths, and silver have become more frequent as the energy transition intensifies. Renewable energy systems require different metals than traditional fossil fuel-based infrastructure. Solar photovoltaic capacity in particular has grown rapidly, and silver remains a high-performance conductive material for photovoltaic cell manufacturing. Some research institutions estimate that solar panel production accounts for a meaningful percentage of annual silver demand. Electrification trends in automobiles introduce additional components that require conductive metals. Defense manufacturing similarly requires materials that operate reliably under extreme environmental conditions. From satellite systems to radar components, mission-critical platforms incorporate conductive metals that must be durable, precise, and thermally stable. It is within this broader industrial and strategic framework that the emergency G7 meeting became noteworthy. According to publicly available statements, the meeting focused on securing supply chains for critical minerals. While the official communiqué did not single out silver, many commentators speculated that silver was among the materials of interest due to its applications and recent pricing behavior. It is common for government communications to employ broad terminology, especially when multiple sectors or materials are involved. Official documents rarely reference speculative investor narratives or short-term trading dynamics. Instead, governments typically frame discussions around supply resilience, industrial planning, and international cooperation. Viewers should be cautious about interpreting government language as confirmation of market narratives without corroborating evidence. Nonetheless, such meetings do indicate that policymakers are monitoring mineral supply issues more actively than in previous decades. Silver has experienced periods of price volatility throughout its modern history. Analysts frequently reference the 1970s and early 1980s as one of the most famous episodes when the Hunt brothers attempted to accumulate significant quantities of physical silver and futures contracts. Regulatory changes followed, leading to substantial price corrections. In 2011, silver reached nearly $50 per ounce during a period of high monetary uncertainty and post-crisis liquidity, before retreating again as conditions normalized. More recently, the 2020 pandemic introduced volatility across commodities, currencies, and equities. Supply chain disruptions, factory shutdowns, and shifts in consumer behavior influenced inventories and logistics systems. During these periods, silver prices fluctuated as both industrial and speculative participants responded to changing environments. However, analysts observing the 2020-2026 period note an additional distinguishing feature: the expansion of global manufacturing in Asia, particularly in China, where solar production capacity, semiconductor manufacturing, and consumer electronics assembly have expanded rapidly. China not only consumes significant quantities of silver, but also refines and exports components embedded with the metal. This means China participates in multiple stages of the supply chain, from raw material processing to finished goods export. Because the United States and Europe increasingly import technologically intensive goods from China, analysts observe that supply chain dependencies are no longer limited to raw mineral production. Instead, dependencies occur across intermediate and finished manufacturing stages. In this context, the G7's emphasis on securing and diversifying critical mineral supply chains reflects an attempt to address multi-layered dependencies that extend beyond mining. Historically, silver held monetary status across numerous civilizations. For many centuries, its primary use was in coinage, trade settlement, and wealth storage. In the 20th century, however, silver underwent a gradual transition as advanced manufacturing and technological applications began to dominate demand. Analysts frequently point to the mid-20th century as a turning point, when photography, electronics, and industrial components began competing with monetary use for the same supply base. Over time, silver's identity became dual: part industrial commodity, part monetary legacy. This dual nature differentiates it from other metals. Gold, for instance, is primarily associated with wealth storage and reserve functions. Copper is typically regarded as an industrial metal closely tied to global economic cycles. Silver occupies a middle ground. Some investors consider it a hedge during periods of currency stress or inflation concerns, while manufacturers require it for semiconductors, photovoltaics, electrical systems, and chemical processes. As a result, silver's price behavior does not always track broader equity markets, nor does it always mirror gold. Instead, it frequently responds to shifts in industrial demand, supply disruptions, mining economics, and policy priorities. The post-World War II era further reshaped silver's market profile. Government stockpiles that once supplied monetary needs began to shrink as nations abandoned silver-backed currencies. For example, in the United States, the Treasury gradually sold off its strategic silver stockpile throughout the second half of the 20th century. By the early 2000s, the U.S. government no longer maintained a significant silver reserve. Meanwhile, industrial applications expanded dramatically. Analysts observe that by the 2020s, silver became essential for solar panel production, battery engineering, medical devices, aerospace components, and high-efficiency electrical technologies. Manufacturers valued the metal not for tradition or heritage, but for its scientifically measured conductivity, reflectivity, antibacterial properties, and chemical stability. In addition, as economies digitized, silver became embedded in server infrastructure, telecommunications hardware, and semiconductor supply chains. When viewed through this lens, it becomes clearer why supply chain discussions have elevated silver to what official statements now refer to as a critical mineral. Whether silver qualifies as critical depends on definitions. However, several governments have adopted frameworks in which materials necessary for defense, technology, or energy systems may receive new classifications. When policymakers discuss critical minerals, they are typically referencing supply sources, geopolitical dependencies, and industrial requirements rather than investment behavior or price outlook. Recent market data indicates that silver inventories at certain exchanges and depositories have experienced declines when measured over specific time frames. Industry observers report periodic withdrawals of physical silver from vaults and depositories, though such withdrawals may reflect a wide range of motives, including industrial usage, institutional allocation adjustments, fabrication requirements, or transfer to alternative custody systems. While some commentators interpret these inventory movements as evidence of systemic shortage, others caution that market inventories have fluctuated repeatedly across decades. Inventory data must be contextualized with production statistics, refining capacity, recycling flows, and industrial substitution potential. Silver mining does not operate independently. The majority of global silver output is produced as a byproduct of lead, zinc, copper, or gold mining. This means production levels respond primarily to the economics of these other metals rather than to silver's price alone. Analysts therefore argue that even significant increases in silver prices may not incentivize immediate production increases. Mining projects typically require long lead times, environmental permitting, community engagement, capital expenditure planning, and infrastructure development, all of which introduce delay. Meanwhile, recycling serves as a secondary supply mechanism. Scrap metal recycling can respond more quickly to price shifts than mining, but depends on consumer behavior, industrial activity, and collection economics. Not all silver-bearing materials are recoverable at cost-effective levels. Certain electronics components contain silver in minute concentrations dispersed across millions of devices. Recycling such materials requires specialized facilities and may not always produce sufficient yield. As a result, recycling does not always function as a complete buffer against supply shortages. Still, some analysts suggest that recycling may provide partial relief under certain price conditions. These complexities illustrate why supply chain stability has become a policy topic rather than solely a market topic. The role of derivatives, plus paper versus physical frameworks. One of the recurring points in silver discussions involves the relationship between futures markets and physical markets. Futures contracts allow traders to hedge or speculate on price movements without necessarily acquiring physical metal. This mechanism can increase liquidity and facilitate industrial planning by enabling manufacturers to hedge input costs. However, futures markets also introduce leverage, margin requirements, and cash settlement mechanisms that differ structurally from physical spot markets. Analysts distinguish between paper, silver, derivative contracts, and financial instruments, and physical silver, metal held in custody or delivered through supply chains. Some investors monitor differences between futures prices, spot prices, and regional premiums. For instance, premiums may arise when demand in one region exceeds local inventory, or when transportation and refining constraints create bottlenecks. During periods of heightened industrial activity, Asian markets may display premiums relative to Western markets due to manufacturing concentration in China, Japan, and South Korea. Such premiums do not automatically imply manipulation or crisis. They may simply reflect logistical, industrial, or currency-related factors. Arbitrage mechanisms can compress price gaps, though arbitrage efficiency depends on delivery time, shipping costs, regulatory frameworks, and contract specifications. The emergency G7 meeting attracted attention partly because it occurred amid a period in which analysts observed temporary premiums in certain Asian exchanges. While some commentators argue that such premiums represent evidence of physical scarcity, others caution that premiums can also arise during normal industrial cycles. Without comprehensive inventory transparency, it is difficult to draw definitive conclusions. It is true that global markets for critical and industrial metals have become more regionalized. As supply chains reconfigure due to geopolitical considerations, tariffs, and trade agreements, price disparities may become more common. The energy transition similarly introduces demand variability as nations accelerate renewable deployment at different speeds. The automotive sector adds another layer of complexity as electric vehicle production scales. Why governments might intervene. Government intervention in commodity supply chains is not unprecedented. Nations frequently intervene in agricultural markets to stabilize food prices or ensure supply during shortages. Energy markets have historically been subject to strategic reserves, export controls, and coordinated policy responses. In some cases, governments maintain stockpiles of metals required for defense applications. For example, the United States has maintained the Strategic Petroleum Reserve for energy security and has historically maintained critical material reserves for defense manufacturing. Reclassifying silver as a critical mineral may enable governments to use similar policy tools if needed. Critics sometimes argue that such classifications risk distorting markets. Supporters counter that strategic reserves can mitigate vulnerability during conflict, pandemic, or trade disruption scenarios. Importantly, reclassification does not guarantee that reserves will be created, nor does it imply that shortages are imminent. Instead, it signals that policymakers view the metal as relevant to future planning. Multiple interpretations of the G7 meeting. Interpretations of the G7 emergency meeting differ across communities. Some analysts view the meeting as evidence that governments anticipate structural supply issues across several minerals, including silver. Others suggest that the timing of the meeting coincided with commodity price movements but was not necessarily triggered by them. Media narratives can amplify dramatic framing, especially in digital environments where attention incentives favor urgency. However, without explicit confirmation from officials, attributing causation becomes speculative. A more neutral reading suggests that governments are increasingly managing supply chain resilience as a policy priority. Silver may simply be one component of a larger puzzle that includes lithium for batteries, rare earths for motors, cobalt for energy density, nickel for cathodes, and copper for grid expansion. The shift toward renewable infrastructure and electrification means that industrial metals previously viewed as niche may become macroeconomic variables. It is crucial to acknowledge that silver prices, like all commodity prices, fluctuate due to multiple variables. Outcomes are uncertain. Future scenarios can lead to higher, lower, or stagnant prices, depending on supply, demand, policy, technological substitution, or macroeconomic conditions. Historical episodes demonstrate that silver has experienced significant volatility during periods of financial stress, as well as during industrial transitions. Analysts frequently caution that viewing silver solely through the lens of investment narrative may obscure the broader industrial and strategic dimensions. There are risks associated with assuming shortages will necessarily lead to higher prices. There are also risks associated with assuming volatility will deter industrial demand. Manufacturers may seek substitutes or redesign components if costs rise excessively. Similarly, geopolitical developments may either relieve or intensify supply chain strain. Some investors monitor these scenarios, but it is important to reiterate that this video does not offer financial advice, does not recommend investment actions, and does not provide predictions or guarantees.